In this video, I'm going to show you different ways you can buy a house with zero or very little down. You may be thinking, like a lot of people, that you need 20% to put down to buy a home, and that's flat out not correct. So let's get into it. I'm going to show you specific examples of low down and zero down, and then we're going to do a side-by-side comparison to show you the difference if you chose to wait to put 20% down. Did you know that 60% of people put 6% or less down when they bought a house last year? How's that for some hard numbers? What you need to understand when you are buying a home, there are lots of options out there. Options out there as low as 0 down, 3% down, 5% down are great options that are available that many are taking advantage of, and you can too if you understand the numbers. And you also need to understand if you qualify for these programs. If you choose to stick around, I'm going to get to it in detail, and you're going to be a lot more informed than the other side of this video. Here's the reality. If you really pulled your belt tight and you saved and saved and saved, and you found another $10,000 to put down, it would probably only change your monthly payment by only $70 or $80. And you know what? If it took you a year to do that, if that house was going to appreciate 5% in value, guess what? You didn't really save anything. So now that you know all this at a high level, let's get in the weeds a little bit and talk about some programs that are out there, starting with some zero down options. Now, the first one is going to talk about a VA loan, and you have to be a veteran to qualify for this or be married to a veteran that qualifies for it. So it doesn't apply to everyone, but it is a fantastic program and part of your benefits being a veteran. Truly zero down and no monthly mortgage insurance. That's one program. It's not the only program, and many won't qualify if you didn't serve our country. If you did, thank you for your service, and you really need to do a deep dive on a VA mortgage. At a high level, a VA loan is going to be a 30-year fixed rate mortgage, typically zero down and no monthly mortgage insurance. At a high level, what mortgage insurance is, generally speaking, when you put less than 20% down, you pay a fee that doesn't insure you, it insures the lender of your performance. VA does not have a monthly mortgage fee. Now, VA does have an upfront fee, but it's not out of pocket. It is a fee that's added on the loan, and every veteran pays it, but it's not an out-of-pocket cost. So truly, buying a home with zero down, VA is a fantastic program. If you're a veteran, this is a great program because you can come in with zero down instead of trying to save 3% or 5%, or even thinking you've got to go all the way to 20%. The next type of loan to talk about that's a true zero down financing is USDA Rural Development Loan. Now, you might hear the word rural development and think, I don't want to live out in the sticks. Maybe you do want to live in the sticks, but you might think, oh, that's rural, that wouldn't apply. It's amazing on how much the country fits into a rural envelope. You wouldn't think it was really that far out. In my home market, we get about 5, 6, 7 miles outside of town, and the whole area surrounding it is rural. A lot of these bigger metropolitan areas just outside, probably where these metropolitan areas continue to grow in time, fall into this rural area. This loan allows you to buy with zero down. It does have a monthly mortgage insurance fee, and it does have a small fee paid up front to USDA, but at the end of the day, the mortgage insurance is very small and also allows you to get in with zero down. So you're not trying to hustle to save that down payment. You can buy truly right now if you qualify and if the home meets an area of rural development. What we see in a lot of rural areas is that typically the dollar goes a little further. And let's be honest, a lot of people are working from home or some sort of flex that they're not coming into the office every day. Maybe it's a 15, 20-minute commute on the few days you come in. Maybe you're an extreme case that you're truly working rural and you don't have to be there, where you could really be out and be on some acreage and be away for the metropolitan area, the USDA program is a great option. So those two zero down programs are the most common programs that are available through most of the country. But let's say you're not a veteran. Let's say you're not looking at a rural area. Let's get into a couple other options that are low down payment. One of my favorite mortgage programs is the FHA mortgage, basically backed by the federal government, and it's only a 3.5% down payment. It's the loan I used when I bought my first house, and I'll tell you, fantastic program with just 3.5% down. One of the big advantages of FHA loan is it focuses on recent credit history. You don't have to have 800 credit score to get an FHA loan. Matter of fact, if you had an 800 credit score, we'd probably be looking at a different program for 3% down. FHA can go into the lower credit score pieces. Generally speaking, in the low to mid 600s is a good credit score for FHA. There are some exceptions where they can go lower. There's some exceptions where you may not even need a credit score. FHA is one of my favorite programs. It is a 30-year fixed rate loan. You will pay monthly mortgage insurance, and you also pay an upfront insurance fee that gets added on your loan to help secure the program so it's available for a long period of time. Getting into the 3.5% program for FHA in the next program I'm going to talk about, both of these programs allow a gift from a family member and in some cases a family type relationship. In addition, there are some grants out there, and those grants are local grants done at a state level in a bond program where you can get everything from a gift to a forgivable loan or just a loan to possibly be used for this down payment. Those options are available, and they're available state by state. Let's move into a scenario with a low down payment with someone who has better credit. When I talk better credit, I like to see this in that 700 and above credit. 700, 720, 740, 760, 780, 800. Those are kind of those upper level tiers of credit. In that credit score, if you have that, you'll probably be looking at a 3% down conventional loan program. The biggest advantage of this program is that there's not an upfront fee paid like FHA with a conventional loan. With FHA, it's 3.5% with monthly mortgage insurance, and also a fee is paid to FHA. It's added on top of your loan, so while it doesn't come out of your pocket, you do owe that eventually when you pay the loan off. With a conventional loan, it's 3%, and you're only paying a monthly mortgage insurance fee. That monthly mortgage insurance will stay there until you pay your loan down to about 20% equity in that. So again, this program with the monthly mortgage insurance that will eventually go away once you pay your debt down, kind of a higher level conversation would be, or if you refinance at some point as the equity in your house builds, you pay your loan down and interest rates come down, could also potentially refinance out of this mortgage where you wouldn't require mortgage insurance anymore. Remember, this 3% conventional loan and the 3.5% gifts are allowed for the down payment. That can be a gift from a family member or possibly a state grant, state loan, a bond program. I want to talk about one other thing, which is a really big misnomer regarding mortgage insurance. We're doing a lot of mortgages right now with individuals that fall into a low to moderate income piece where there are special programs with lower monthly mortgage insurance and lower interest rates. Let me give you a great example about mortgage insurance. I was always taught, you don't want to pay mortgage insurance. Save the money, put it away, save up. You don't want to pay mortgage insurance. Let's get to the fact on how much mortgage insurance is right now for someone putting 3% down on a conventional loan. High level, it's going to change depending on credit and a variety of other things. So let's take an example of a $400,000 house doing a conventional loan, putting 3% down with someone that has really good credit and they fit into this low to moderate income bracket. Now, this bracket changes around the country with where you live and a variety of other things, but let's say some of the 780 credit score that fits into that window. That $400,000 loan, rough math, the mortgage insurance, and that's the fee you pay because you put less than 20% down, would only be around $65 per month, somewhere in the neighborhood of $780 per year. So I want to just take a really big step back and think about this. 3% down on a $400,000 loan is $12,000. You're paying a fee that works out annually to about $780. Every market's different, but I want you to think about this. Most experts agree on a very, very conservative level because we have a shortage of housing, because everything's more expensive, because of a variety of things, we are going to continue to see house prices move up in most areas in the country. Again, every market's different. I personally think in my market, 5% to 7% would be conservative. Let's take that $400,000 house and let's take 5% times a $400,000 house. That house has a very strong potential to appreciate by $20,000 in 1 year. That continues, that's $40,000 in 2 years. If you got in with 3% down and you paid $780 for mortgage insurance, I'm going to round it up. Let's say it was $1,000 in mortgage insurance for year one, $20,000 with equity, $1,000 fee because you didn't have 20% down. Over 2 years, $40,000 of equity and $2,000 of fees. The old adage of wait, save, you got to have money, you got to have 20% down. It just doesn't apply to everyone. It's not one size fits all, and mortgages are individual. There's lots of programs, and sometimes a little bit of information is more dangerous than no information at all. Okay, so hopefully you're looking at this and saying, maybe that house isn't out of reach that I thought it was. I think I could scrape together 3% or 5% or maybe qualify for a zero program. I want to sweeten the pot a little bit. I want to talk about a couple other strategies where you can get in without a bunch of extra costs. When you buy a home, in addition to down payment, you have closing costs and you have a thing called prepays. These are items related to buying the house. Closing costs are things like appraisal and title work and lender costs. Prepaids are things like paying your first year of homeowner's insurance, establishing what's called an escrow account. Every month when you make your monthly payment, the lender holds money aside to pay your future property tax bills and your homeowner's insurance. So these two items, they changed throughout the country, different costs, different fees, but generally speaking, the rules are the same for these. You can negotiate to have the seller potentially pay your closing cost and prepays. So let's take a scenario where we have a 3% down program on a $400,000 house. Let's say you've got a mom or dad that's going to help you out with the down payment, or you've pulled some money aside and you've got your 3%, but you just don't know about that extra money that's going to be out there. How much is it going to be? Let's say a scenario that it was maybe $8,000 of closing cost and prepaids. You could negotiate to ask the seller to pay your closing cost and prepaids up to $8,000. I'll give you a couple high-level scenarios here. Let's say we got to $400,000 and that seller doesn't want to sell that house for a penny less than $400,000, and you think it's worth $400,000. You could actually offer $408,000. Ask the seller to pay $8,000 of your closing cost and prepaids, and you would be bringing just your 3%. You do the same thing with a zero down program. You can do the same thing with a VA program. So all these options are available to negotiate to have the seller pay your closing costs and prepaids. And it doesn't always mean that seller is going to take less money. The seller is going to look at your offer, subtract the amount of money they're paying in your closing costs and prepaids, and see if it fits for them. It is a great option to get in with low down payment and low to no additional closing costs paid by you. What's happened with the market is because the market in a lot of areas has become more condensed and more competitive, sometimes sellers are worried that if someone's coming in with a lower down payment and they're asking for closing costs and prepaids, that they may not be well qualified. And I'll be honest with you, that is real depending on your market. Let's take a market where there's 10, 15, 20 offers on a property. Do you think that offer with 3% down and asking to pay $8,000 in closing costs and prepaids is going to win against a cash offer or win against an offer with someone with 20% down? Probably not. I can give you a couple things that could increase the likelihood of you winning. One would be working with a reputable lender that has a great reputation. So that listing agent and that person selling the house knows that this lender is going to perform. This lender is going to be there. The likelihood of this closing is very high. So That can help when you're in a highly competitive market. The other time you will have more success in negotiating with the seller paying closing costs and prepaids is when you're in a market that's very much a buyer's market versus the seller's market. A buyer's market means there's not very many buyers out there and there's a lot of houses for sale. If that's the case, that seller of that home is going to work with you every way they can to make this happen. The old car joke, what's it going to take to get you in this car today? Think about it from a house. Hey, what's it going to take to get you in this house today? Well, here's what I need. I need $8,000 of you paying my closing costs and prepaids. So a lot of that will come into place. Right now, it is tougher to get the seller to pay closing costs and prepaids in a lot of markets. Not impossible, but tougher. It is easier when the market's slow. Even in a busy market, you have cycles. My main base of operation is in Michigan. Gets a little slower October, November, December, January. As I'm filming this, we're heading into a spring market, becoming more competitive in a spring market. So there's an ebb and flow and a sway to every market. Talking to a local professional will help get you in the right direction from a real estate piece, talking to a real estate agent to say where you need to be and what your market's like right now. So high level, talking about 0 down, 3%, 5%. Kind of pretty much just talked about your primary residence and just living here. And we probably, both of us probably just assumed we were talking about a primary residence, single family house. That's just single family. You're going to live in it. You're going to own it. Talk about a couple other concepts that also apply in a low down environment where you could potentially buy a home with that same low down payment, with that same strategy of potentially negotiating to have the seller pay some closing costs and prepaids. But you could look at buying a multifamily property. That's a house that would have 2, 3, or 4 units. Maybe it's a small apartment in there. Maybe it's a 2-unit with upstairs, downstairs. Maybe it's a split duplex. Maybe it's a 4 exactly identical units in the same building, a 4-unit place. FHA allows you to buy this with as little as 3.5% down. The great thing is that you can use that rent to help offset your cost in your monthly payment by generating revenue and generating income from renting those other units out. This falls into a house hacking piece where maybe that's your first purchase, that you go and you buy that and you live in one of the units, you rent the other 3 out for a couple years, build some equity, turn around and go buy a new house, throw a tenant back in the unit you used to occupy and move on to the next property. Great example of house hacking. You moved in, you lived in it. That was your intention. You lived there for an extended period of time. You turned 3 rental units into a 4th rental unit, and you turned around and potentially did the same thing again. Great example of leverage, of using a small down payment, potentially getting seller to pay your closing costs and prepaids, get in, and have those tenants basically pay off your mortgage over the next 30 years. In many cases, the rent coming in the 2nd, 3rd, 4th unit can dramatically offset your monthly payment, potentially cover your whole payment, potentially even create a spot that you're making more than what your mortgage payment is. Now, I want to be realist. There are expenses to owning a property. It's not always awesome and there's positive cash flow and it's great and things are going to happen. And there are some risks and there are some headaches with rental properties and owning rental properties. But I love that concept of you living there, you owning it, you're being there as you're starting to build some wealth in your first rental property. If it performs really well, rents continue to go up, your interest rate is locked in on your mortgage, the equity of that property continue to go up, and those tenants are potentially paying your mortgage off and even kicking off some positive cash flow. Hey, there's some other programs out there, lease-to-own, seller financing. I'm going to tell you, most of them are a bunch of smoke and mirrors. If you can't get a mortgage, maybe you shouldn't be buying the property. I'll tell you, some of the stuff I've seen out there over the years, it just doesn't make me sleep well at night. Land contract deals and shady dealings and sign this quitclaim deed and do this and you can lease it for 5 years, then I'll sell it to you and you'll own it. I'll be honest with you guys, few of those I've ever seen work out very well. Big thing is working your credit. Get to a spot that you can go to a reputable lender, get a mortgage, get that seller financing out of it. Get them out of it. You buy it. You buy it with a low down program. You buy it when your credit score comes up. You buy it when your income is where your income needs to be to qualify. I think a lot of these seller finance deal, these lease option deals are just not good. In my professional opinion, in most cases, steer clear. All right, great. I would love to put some numbers together to support what we've talked about in this video. And what I'd like to share is an example if you're looking at putting 3% down today versus waiting to get a 20% down payment. Let's look at some real numbers. And I'm always conservative in my numbers. So when I use these are examples I feel very strong. These are conservative approaches. Put some numbers together. So let's try this. Let's take a $400,000 purchase price and let's look at a 3% down mortgage. So that's $12,000 as a down payment. That's going to leave us with a loan amount of $388,000. Let's use a number of 6% in a 30-year fixed rate mortgage. That monthly payment would be about $2,326. If you qualify and fall into some of the really good low payment mortgage insurance options out there right now, some of them for first-time home buyers, some of them for low to moderate income, whole variety of different programs like we talked about earlier, that mortgage insurance might be somewhere in the neighborhood of $60 per month. I'm going to call property taxes. They move all over the country, but for this case, let's call it $400 a month for property taxes. And again, homeowners insurance moves throughout the country. I'm going to say homeowners insurance is about $1,800 for the year, so $150 per month. So if you chose to buy now on a $400,000 house, that total estimated monthly payment for this general ballpark equation would be about $2,936. I like to call that PITI, principal, interest, taxes, as in property taxes and insurance, $2,936. So let's take the same $400,000 house and let's say we've decided that we want to save for the next X amount of years to get 20% down. So wrapping up the 3% option, we're going to call it $12,000 for your down payment and a monthly payment of $2,936. Let's go over to a scenario that says I'm going to save and I'm going to get 20% down to save for that house because I don't want to pay mortgage insurance and I'm going to save that money and I'm going to put 20% down. How many years is it going to take to save from $12,000 up to $80,000 on a $400,000 house? Let's say it takes 5. A couple things here. Where did you live for those 5 years? You still living in mom's basement or did you rent an apartment? And how much was that apartment? And how much did that apartment stop you from saving that additional money? But let's just say your living scenario is free. It didn't cost you anything additional. How long is it going to take you to save that 20% down on a $400,000 house? Here's the next kicker. Conservatively, that $400,000 house in 5 years at just 5% appreciation over 5 years is going to be about $500,000. It now requires a $100,000 down payment if you're dead set on, I have to put down 20%. So now $500,000 loan, putting $100,000 down means you're borrowing $400,000. Let's use that same general interest rate of 6%. That monthly payment is $2,398. Great news. You're not paying any mortgage insurance, so you're not paying that roughly $60 a month. Let's use the same property taxes, $400. The reality is your property taxes will go up over this period of time because the house sold at a higher price, but let's just use $400 for this example, the same as we did at 3%. We're going to call homeowners insurance $1,800 a year. Again, that's $150. So that total monthly payment, $500,000 purchase price, putting $100,000 down, borrowing $400,000, $2,948. So in the 20% down example, we need to come up with $100,000. And our monthly payment is about $12 higher. So wrapping this up, my professional opinion, I like to see home buyers getting in sooner, and it's okay to put down a lower down payment. I think the numbers I gave you, the example I gave you are just one. I think a 5% appreciation is conservative. I think getting in and building equity early on is really good. My suggestion with most clients, take a hard look at putting less money down in getting in earlier. Hey, if any of this has struck a nerve or you have some interest and you want to book some time with me, I'd love it. Click the link below to get a time scheduled with me or someone from my team where we can talk about what options are right for you.